Well, the markets take another quiet day to think about things as they wait for more event risk to hit the wires. We're, of course, still waiting to see how trade negotiations between the U.S. and China are going to go. We're still waiting for the start of economic data to really hit the wires this week. And that's what we're going to focus on here today on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And for the next 30 minutes, we're going to see if we can break down what will be the first big piece of economic data this week and whether the markets should care about it. And of course, what we're talking about here is US CPI data. We have in front of us what is the first kind of big piece of data for this week, and of course a week full of low volume drift in markets. So the hope is pretty much any place you might find yourself in the bullish bearish divide, that you get some conviction, that you get some sort of follow through and some kind of a break of the lull that we've seen here. So what we're going to do is go through and see what is expected, what that means going forward, and whether the markets should care. Now, the expectation here is we're going to get inflation ticking higher for the month of May, 2.9% expected on the core reading, excluding food and energy. That's the metric that the Fed cares most about, of course, because they don't really have much by way of agency over data that might speak to what's going on global food and energy markets. They can't exactly will those prices this way or that. And in any case, we can see from the breakdown here, almost all inflation for quite a long time now has lived overwhelmingly in core services. And so with that in mind, that's really the metric that we are most focused on here. And on that score, we are looking at the most significant inflation if we get expectations met here in 3 months. 2.9% would be a 3-month high, getting back to where we were or approaching where we were in February at 3.1%. It's a similar story for the headline, 2.8% in February, 2.5% expected. Likewise, a 3-month high. Now, in April, these numbers were, from the market's perspective, certainly, encouragingly normal. And what you see here is the contributions to those numbers. You can see the headline was 2.3%, down from 2.4. The core was steady at 2.8. The core services component overwhelmingly the main contributor, but perhaps the most significant thing here was you didn't really get a surge in goods inflation, which is what you might have expected given all of the Fed's worrying about the onset of tariffs. And of course, in April, we very much saw a significant increase in tariffs, the pause in reciprocal rates beyond 10% notwithstanding. Taking that pause as it occurred, you still had a move from the average tariff being 2% to the average tariff being 10%. So you have a 5-fold increase in tariffs. And the worry was that what this would mean is a significant increase in goods inflation that would hurt consumption, that would give you a nudge on the part of the economy that is the most significant. We've talked a lot here on Macro Money about the first quarter being the weakest contribution from consumption to overall GDP in close to 2 years, while at the same time accounting for 68.5% of GDP overall, which is not what you want to see. Certainly, that consumption is the dominant thing is the standard for developed economies, but that's why you don't want it at a 2-year low. So the concern was that you'd start to see that show up in surging goods inflation, and when that didn't present itself in April's CPI numbers, this was met with a lot of encouragement by the markets until, of course, you got the PPI results and you saw where that inflation went. Here is the month-on-month change in wholesale inflation, excluding food and energy. And you can see we're looking at some of the fastest rates in April going back 2 years. There's that big errant spike in 2023, and if you look through it as a one-off, as it looks to be, then you're going back to kind of the worst of the inflation surge in 2022 for your reference point. But that didn't show up in CPI because you can clearly see here what's going on is businesses ate the difference. They basically took a hit on margins, and you see here the negative reading on month-on-month PPI here, and you can see it appear in what is called PPI for services. This is the trade services component, which basically represents the cost of moving goods through the supply chain once it's in the U.S. And you can see here the hit on margins and ends up being something like 1.6%, which is quite a big hit for a single monthly change. So that drop in margins tells you that, as you helpfully get annotated here from the chart that I pulled from Bloomberg reporting on this, you get this hit to margins, and that's where the price increases have gone. That's how they're not, for the most part, in CPI. Now, looking forward, the ISM numbers that just came out last week tell you a story of very significant price pressure. It's evened out at a high level in manufacturing, apparently, over the past 2 months or so. That's somewhat encouraging, at least in the sense that things aren't getting actively worse. But in the service sector, you've had a dramatic catch-up. In fact, you are now looking at the fastest inflation, according to this ISM survey data, for services, which is by far the largest component of the economy. If manufacturing is maybe something like 20%, and ag is maybe something like 10, then the rest is services. So about 70% of the overall economy. That's now at the fastest since November of 2022. Kind of comports with what we're looking at here in PPI, absent again this errant spike in 2023. What's more striking is that you get this runaway inflation at the same time that the sector contracts for the first time in, give or take, a year. You'd have to go all the way back, and granted it's a narrow contraction, but you'd have to go all the way back to December of 2022 and then to April of 2024 to get some recent readings below 50. And you can see here that, at least sort of referencing the middle of last year, this is the weakest that the service sector has been, and of course manufacturing had this run up around the front running of the tariffs, but now seems to have had that fizzle as the tariffs have gone from speculation to reality. And so it isn't as though you are getting this jump in service sector in inflation here against the backdrop of growth becoming stronger. That would be the kind of thing that's driven by robust demand and would be generally a source for optimism. That isn't what's going on here. Inflation is surging here at the same, and you can see the base here is the beginning of this year for the most recent bit. And of course, over the same time, what's happened with growth in the sector is it has been cooling. And again, this is the largest sector of the U.S. economy. So if ever you wanted a picture of stagflation risk, there it is. Moreover, that price component of the ISM services report has tended to anticipate with about a 2-month lag what happens in CPI as well as the Fed's preferred gauge of inflation, the PCE index. You can see that obviously the ISM survey is more volatile, but you can see that in broad strokes, there is a trend following a kind of parallel set of developments here if you lag the PCE and CPI indices by 2 months. And of course, what that anticipates is if this now is an inflationary surge, most recently going into April and May, that should begin to show up right around the next several months in CPI and PCE, even if it doesn't show up necessarily in this month's data. So the risk is in the direction of reflation. And of course, these things aren't perfect. These relationships aren't one for one. So you'd have to set aside the idea that you know that this is going to happen this month or you know that it isn't. What you do know, though, is there has tended to be this relationship, and it would tell you that over the next several months, looking out for a jump in inflation readings is what you'd be looking for, which, of course, the Fed no doubt sees. Moreover, when we had a similar type of situation last year, we saw inflation accelerating here. These are CPI monthly changes in 3-month and 6-month annualized increments, which the Fed looks at to kind of get a sense of the higher frequency trends in where inflation is heading. Even though they target year-on-year annualized, or 12-month annualized, they look at these inputs to kind of see where the wind is blowing to try to anticipate, at least to some extent. And you can see that last year, as you had inflation building at the start of the year, the Fed, of course, became reluctant to cut rates and didn't ultimately cut them until here, September. While the president has said that the ECB has cut rates 10 times and the Fed has done none, that's, of course, not accurate. The Fed cut rates the equivalent of 4 times last year, 1 time by 50 basis points and 2 times by 25 basis points, which begins right here. But by then, this inflation spike that kept them on the sidelines and waiting was already quite a few months in. Now, of course, you don't have a Fed meeting in August, but as far as months with a meeting, here we go. They didn't do it in July, they didn't do it in June, and that was already 4 and 5 months since the spike, or the peak in this reflation. Now, arguably the peak in this one is sometime around January, February, and this would only be the 3rd or 4th month, depending on where you sort of tag this. That would be the 3rd or 4th month since. So Under better circumstances last year, the Fed wanted to wait longer to really make sure that it's back on course to start cutting. So even if you get a reading in line with expectations here that doesn't muddy the waters, you're probably not looking at Fed action being motivated by whatever comes out. And with expectations as they are and with the muddiness there, you probably just endorse that. Moreover, in the same direction, we've been talking about this reporting from the Wall Street Journal this week and last, casting doubt on the veracity of CPI figures to begin with, because the hiring freezes and layoffs at the federal government since the beginning of the year have meant that the Bureau of Labor Statistics, which puts these data together, have had to rely much more so on implied figures rather than actual surveying of the economy and of the price levels in it. You can see here that normally before COVID, about 10% of the data was using these implied estimate methods because for whatever reason in a given month, a certain price point couldn't be had by the time the survey period was over. During COVID, not surprisingly, during lockdowns, we got up to just a touch over 15%, which you can see already normalized by the beginning of 2023 back to around 10%. But over the past 2 months, and of course, especially in April, it's surged to approaching 30%, almost 3 times what's normal. So whether you want to say you should trust the number or not, it really isn't the point. The point is, if the Fed wanted to see lots of evidence to prove to it that inflation isn't going to be a problem and it can start to cut rates despite its concerns about the tariffs being inflationary, this kind of fuzz in the data just means they need more data points. So they need to wait even longer. Now, from the market's perspective, not surprisingly, what all this means is a very modest outlook for rate cuts this year. You can see the markets have gone to 39 basis points now for this year. That's less than the Fed's preferred 50 basis points that they initially projected in December and reiterated again in March. It leaves 14 basis points of a second cut on the board. So 39 is 25 basis point cut, one fully baked in, and 14 basis points in the direction of a second one that puts the probability narrowly better than even at 56%. Then for next year, you have just about the Fed's forecast matched here, 53 basis points baked in. In all, that's a little bit lighter than the Fed's 100 basis points, but very close at 92. But you do get the sense that the easing is moving into next year. So as you start getting under 50 for this year, you start to flirt with the idea, especially last week, that you might get over 50 next year because the Fed's dithering will mean more rate cuts later. But timing-wise, looking at this year's curve, you're barely priced in for a rate cut in September. It's about a 50-50 shot. It's there by the time you get to October, and then you're about halfway to the next one when you get to December. But very clearly here, the market does not anticipate a cut when the Fed meets next week, does not see one in July, and is tepid for September. You can see the curve now meaningfully more hawkish than it was in the beginning of May when the Fed met, and in many ways more so even than when the Fed met in March, the last time they updated their summary of economic projections. So what does all this mean? Of course, the markets have believed that the Fed isn't going to cut in June and have been wishy-washy on July for quite a while. We've heard from the Fed at length that the problem facing them is that you have a situation where the tariffs as a basically sales tax on imports are going to be inflationary. And we've seen evidence of that show up in the PPI numbers. It's just so far they haven't been passed on to consumers. We're starting to see that pass through happen, looking at the PMI data, including the ISMs. And that sort of encourages the Fed's perspective that they need to be careful about cutting rates lest they let the inflation expectations demon back out of the cave where they have been trying to lock it for the past several years. And at the same time, they're concerned that what the tariffs will do in increasing prices for consumers is act as a dampening of sort of force on the economy, which of course we saw in spades in the ISM numbers that we just looked at. The economy has very clearly slowed since the tail end of last year going into this year. So what does all this mean taken together? Well, the markets have seemingly made their decision, and they're not leery about rate cuts, because what we see here as we compare inflation expectations, so-called break-even rates in the bond market with the S&P 500, is we see that when in the middle part of February, the tariffs started to show up in reduced business confidence and consumer confidence and started to sow recession fears, stocks were going down as inflation expectations were falling around that economic slowdown idea. Stocks have rebounded clearly. They're back to basically where they were at the start of the year, but these break-even rates have not. They're still suggesting that the risk is that inflation is lower, not higher, because the impact from tariffs will be a growth downturn, not an inflation shock. And that's where the Fed needs to focus. So if you get CPI data that confirms the Fed isn't going to come and move sooner, while the markets seem to think that they should, because the Fed hasn't made up its mind, but the markets have, well, then that just means the Fed is going to allow a deeper recession, and that may well see stocks shaving some of this sentiment wedge away and turning lower. It may also see gold go up as speculation builds for more rate cuts downwind as bonds rise and the dollar weakens. That is macro money for today. Come back tomorrow, as we do every Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, to see how all of this worked out, of course, and how to think about what comes next. In just 30 minutes' time, I'll be on with Victor Jones for The Price of Truth, so come see that as well. I'm back with Chris for Futures Power Hour on Friday, back with Victor and Tom for First Call on Sunday, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money returns tomorrow. Happy trading.